I'm Lydia Tomkew, hedge fund reporter with Fundfire Alts, and joining me is Nigol Koulajian, founder and CIO of Quest Partners. I wanted to ask, what are the types of questions and concerns you've been seeing from clients in the current market environment?
Our clients, which are typically large pensions, are quite concerned about the tail risk in their positions. So it turns out that as investors have chased higher Sharpe ratios and trying to chase the market overall, there's a type of risk which has become highly concentrated and quite hidden in portfolios, and that is the risk of convexity. Effectively, the fact that volatility is no longer stable. The market is going up slower and slower and then going down with faster and faster moves. That type of instability in the volatility is something which is quite difficult to hedge, and hedging it is quite expensive directly in the market. So typically, prospects come to us with the idea of looking for a way to hedge that in a cheap way.
We've seen a rise in interest and a lot of headlines on quantitative strategies, machine learning, artificial intelligence. They've all become buzzwords. It's a space you've been in for many years. What do you see coming in the next few years as this interest grows and a lot of folks are making hires?
I think there's a knee-jerk reaction going on to active management, which have been proven to be not so valuable in the long term. So on one side, people are going towards indexing and smart beta, so pure replication. So optimization is something which is quite delicate in the markets. This is not a static process from a probability perspective. So you can have something which is highly stable short term, which will turn out to be extremely unstable in the long term. So optimization, even within without the techniques of machine learning, are quite unstable. As people, I would say 99% of the time, optimizations turn out to be not so useful. With machine learning, the ability to over-optimize or to analyze very large data sets is magnified tremendously, and therefore the danger of over-optimization becomes quite tremendous. What we see is everybody is trying to get into the space, but the learning curve is quite steep. There are many levels of stability that need to be understood prior to being able to use machine learning. And I think that many people are going to be disappointed with the results they get. Initially, anything that becomes popular in the market tends to produce very positive results. But then there's always a very extreme mean reversion. So if everybody decided that on Tuesday the market goes up, the market will go up even more reliably on Tuesday for a while, and then there will be a massive reversal. With machine learning, people are able to learn patterns which are highly unstable in the short term, reinforcing them, but that will create a type of instability in the market which is going to be quite painful. So markets are not statistically stable. What is learned by the market participants will actually inverse once it is crowded.
And we've seen a lot of traditional hedge funds, sort of the big name players, now also bringing on small amounts of people in some cases with quantitative skills and having them look at data, perhaps not trading yet. What do you think clients or people should be looking at, the questions they should be asking managers evaluating these hires and how they're going to fit into a firm?
Yeah, so we think that the most important measure of stability is convexity, which means how stable is the volatility of the strategies that these quants are generating. And I'm going to say again, 99 times out of 100, the quants that we work with or we speak to are typically relying on negative skew to generate alpha to the indices. That alpha is not skill-based, is highly cyclical. So differentiating between alpha, which is statistically stable, which is positively skewed, from alpha, which is negatively skewed. So if investors are able to push their managers to focus on positively skewed alpha, they will have returns which are much more stable going forward. That risk measure is not embedded enough in people's mindset in order to be it's highly important today. I would say the new CAPM should be based on convexity, no longer based on volatility or market beta.
Thanks so much for joining us.
Thank you, Lydia.